Hi, folks. This is Mike Zlotnik, Big Mike, and today's discussion is going to be all about the benefits of investing in a high interest rate environment. Before we dive into that topic, usual disclaimer, this presentation is for informational educational purposes only. No solicitation of any kind, no advice is given. Consult with your attorney and CPA professional before making any investment decisions. If you're interested in any of our funds or syndication, request PPM, private placement memorandum to accredited investors only. Now, let's talk a little bit about, we will talk about interest rates, real estate, and why investing in a high interest rate environment may be attractive. What are the pluses and what are the minuses? So recording this video in early June of 2023, when the interest rates are relatively high. And what I mean relatively high is that we were at zero interest rate policy ZIRP not long ago. Federal Reserve started tightening interest rates only about a year and 3 months ago in March of 2022. So on a relative basis, the interest rates are high now to where they used to be. Now, on a historic basis, you could say, hey, the interest rates were way higher than they are now years ago. And that is true. However, one of the most important concepts that folks don't quite understand is many years ago, debt to GDP ratio was way higher. So during the late 80s, when the interest rate was very, very high, debt to GDP ratio was around 50 to 60%, meaning that the debt relative to the size of the economy was way lower. Now a debt to GDP ratio is well over 100%. And in reality, US economy can't really afford those super high interest rates. So the interest rates appear to be high on a relative basis, given the size of the US economy today. And the Federal Reserve is at the very end of its tightening cycle, most likely. Again, all this stuff is speculative in nature. We don't know. If inflation continues to be hot and heavy and things get out of control, the Fed may have to tighten further. Nonetheless, the likelihood is that the Fed has done enough damage to the economy is cooling, and that policy of demand destruction is working, and inflation should be coming down meaningfully. And as a result, Fed is unlikely to be pushing rates a lot more from this point on. So we're kind of at the peak of the credit tightening cycle. Now, let's talk a little bit about the current environment and what it does and what are the opportunities to invest in this environment. So with a high interest rate environment, the most obvious thing that would appear to be interesting is to invest in debt. In other words, investing into instruments that generate high yield. As Fed push the funds rate up, many investments, yield-generating investments, are paying more. The easiest and the simplest category are US Treasuries. So these are notes offered by the US government, guaranteed by the full faith and credit of the United States, and they're considered to be near or zero risk. And they're paying pretty attractive yields, especially on short duration maturities, anywhere from 1 month to 6 months. The interest rates in today's environment are over 5% on many of these treasuries. And that appears to be attractive. And that's a way to park cash, essentially risk-free. There are other debt instruments. For example, investing in hard money loans, either mortgage pool funds or individual notes, where the interest rates on these loans have gone up. So what used to pay, say, 7-8% could pay now 9 to 10 or 11 to 12, even higher. And these type of investments just look more attractive in this environment. Now, general credit conditions have tightened quite a bit or are tightening. So many lenders prefer not to necessarily push the rates up, but just tighten the underwriting, reduce loan to value ratio, underwrite borrowers tighter for better quality, better liquidity, better strategy. Some of them have done both. They tighten up credit conditions and they've also increased the interest rates. So all those factors make investing in some of those strategies attractive in this environment. Again, those strategies are typically short duration bridge loans. They're not designed for long-term investments, but they are something that folks can consider in this environment of high interest rates. So again, investments that generate debt, returns, interest payments with good underwriting may appear to be an attractive strategy in this environment. What about equity? What about equity investments? Well, let's dive into that. So equity investments at this time may appear to be generating less cash-on-cash return, which makes total sense. The reason for this is that most equity investments use debt and they borrow to a certain degree. Let's use an example of a self-storage project. Most of these projects are financed in this environment, relatively low leverage, 50 to 60% leverage. In other words, the mortgage is 50 or 60% of total capital. Investors put up, let's say 60%. They put up 40% equity and 60% debt. So in this type of transaction, as debt costs have risen, the interest rates on loans have gone up, the returns on equity have gone down. So a few years ago, you could get a starting yield on your investment in a self-storage space, for example, at 8%. Today, it's way lower than that. It's a lot harder to get that kind of yield. It's almost impossible. It has to be in a unique project, not a very typical, to get 8% yield from the start. Very, very hard in this environment on equity. So returns, the cash and equity have most certainly shrunk in this environment. However, there may be a greater opportunity to get distressed projects. So as interest rates have gone up, they've created a lot of distress and creating a lot of distress for equity owners, especially if they borrowed on a bridge loan and they haven't completed their value at work on time and their loan is resetting, interest rate is way higher, and you may have rate cap expiration or rate cap maturity. And as a result, they're pressured to sell. So these distressed sellers, not the assets necessarily, but distressed sellers, can probably start lowering the prices, and they're motivated to sell. They give buyers better opportunities. So on a buying front, as you're deploying fresh equity cash, it might appear that the initial yield is lower, but you're getting a better price. So the appreciation, future growth may look more attractive. So something to keep in mind, investing in this environment in equity is likely to generate lower return cash on cash, lower distributions, but it can generate higher total return simply because you're getting better deal on purchase. Again, assuming you can get a great deal. Now, this is all about buying from distressed sellers, opportunistic, strong deals, not general market purchase. So from that perspective, the deal itself has to be way better than what it was before. In addition, there's a phenomenal opportunity to refi when the interest rates cycle down. So equity investors that can buy today with high interest rate and lock in that rate for multiple year loan, a 5-year fixed with no prepayment penalty, have phenomenal upside when the interest rates cycle down, because the option to refinance always exists when the interest rates go down. And there's protection against the interest rate going up by virtue of getting fixed rate for, say, 5 years. So that's the general benefits of investing in equity today. If you get into a great deal and you have high interest rate on a mortgage, as counterintuitive as it sounds, it's an opportunity to refi when the rates get back down, and that'll improve cash on cash economics, and it'll improve overall target returns. So investing in this environment in equity on the right deals is actually very, very interesting and attractive. It may be something worth taking a look. Of course, there are different strokes for different folks, but I kind of wanted to explain the high interest environment, what it's doing to the investing opportunities. Now, this is commercial real estate where pressure is building up on sellers, that they are motivated to sell because their rates are higher and they don't really have a choice. They have to sell or do a refi, cash and refi. Some of them can't just do it. So the power to consider investing in equity is pretty high as long as the deals are strong. So that's the key point. And debt investing is a way to park your cash, generate higher yield, and wait for greater opportunities. So that's the way to look at the high interest rate investing environment. Appreciate your time and attention. Until the next time.